Namaste friends. Normally, a person has to pay tax on his or her own income. But sometimes, just to prevent the burden of payment of tax, people try to shift or split the income or the source of income to some other person so that tax on such income is paid by another person. Now, to prevent such sort of tax avoidance, income tax has a provision known as clubbing of income. So today, let us examine these provisions. First, let us examine a case where income is transferred. Okay. Section 60 of Income Tax Act deals with this, and it says when income is transferred but not the source of the income or the asset from which income is derived is not transferred, but just the income is transferred. To give an example, suppose I own a house and derive rental income from it. Now just the rental income, I say that it should go to, say, my wife. I don't transfer the property as such, but just transfer the income. So in such a case, the section says that income from such a property will be taxed in the hands of the transferor of the income. So the income of wife to whom income is transferred is clubbed with that of the husband who has transferred the income. There is something called revocable transfer. Section 61 talks about it. It says when as an asset is transferred by means of a revocable transfer, then also the resultant income is taxed in the hands of the transferor. Unlike in the earlier case, here the asset itself is transferred, but it is revocable. That means it can be taken back. So in such a case, income is taxed in the hands of the transferor himself. Meaning of the term revocable transfer is that when the transfer deed contains a provision to transfer the asset back or the transfer of income back to the transferor. Again, to go back to the earlier example, suppose I have a house. Now I transfer the house to my wife for a period of 5 years, saying that after lapse of this 5 years, the house comes back to me. Now this is a revocable transfer. Now either the asset can come back or the income from that house comes back after a lapse of certain period or after happening of an event. It's called as revocable transfer, and in such a case, income from such a transfer would be taxed in the hands of the transferor. Let's examine the payments made to spouse. Section 64 subsection 2 talks about it. It says that first, this section would be applicable to individuals because spouse, that means it is applicable only individuals have can spouse, so section is applicable to individuals. It says any payment which is in the nature of salary, commission, fees or remuneration which is paid to the spouse is taxed in the hands of the other person. Okay, suppose a wife is a recipient of salary or commission, fees, remuneration, whatever the name, from a company in which the husband has got some substantial interest, then the wife's income would be taxed in the hands of the husband. Okay. Now this payment can be either in cash or in kind. Okay. Now this payment should be by a concern in which the individual, that is the person whose spouse receives this benefit, has got substantial interest in that company or concern making payment. Now the meaning of this term substantial interest we will see in the subsequent slide. But for this purpose, for the purpose of this section, what is necessary is individual spouse receives certain benefits like salary, fees, commission, etc. from any concern, either in cash or kind. Okay. But if such a payment is consequent on the professional skill of the spouse, then the restriction is not applicable. That means, for example, the husband, say, runs a business and his wife works there as an office manager. Now she is highly qualified, she has done her MBA, CA and all that. Then in that case, even though salary is paid to the wife, it may not be clubbed with the income of the husband. But otherwise, her income, which is received as salary, remuneration, etc., is clubbed with the income of the husband and he has to pay tax on it. Now here, one important thing is that clubbing is not necessarily only in the hands of the husband. It is clubbed with the person, either the spouse, who has higher income. Okay, suppose wife has got higher income, husband's income would be clubbed with the wife and vice versa. But once the income is clubbed, it is continued to be clubbed in the hands of the same person. Now, so for example, suppose an individual runs a business, his wife works in that organization and her income is assessed or clubbed in the hands of the husband. Now, once it is done, even though later husband's income is reduced, wife's income goes up, even in that eventuality, income continues to be assessed in the hands of the husband unless the assessing officer has reasonable grounds to change the hands. Earlier I said substantial interest. A person must be having substantial interest in the organization which makes the payment to attract these provisions. Now, meaning of this term is that suppose the entity which is making payment is a company, then 20% of the shares which have voting rights are held by that individual either wholly or partly with any relative. In that case, he is said to have a substantial interest in the company. Okay. Generally, it should be equity shares because the section says that these shares should have voting rights and they are not entitled to any fixed rate of dividend. Normally, it is equity shares which satisfy these conditions. In other words, if husband or wife owns, say, at least 20%, either wholly or partly with another relative of the equity shares in a company, then the payments made to her or his spouse, either in the nature of salary, commission, remuneration, fees, whatever it is clubbed in the hands of the person who owns those shares. Okay. In other cases, like say firms, etc., then if the taxpayer or one of his relatives jointly are entitled to total 20% or more of profits. For example, husband runs a partnership firm. Now he is entitled to say more than 20% of profit in that firm. Then in that case, payments made to the spouse would be taxed in his hands. Okay. If, of course, subject to the condition that his income is more than that of his wife. Now suppose husband has got only 10% share, but his son has got 15% share in the firm. Then in that case, the payment made to wife of the partner, that is the husband, so that is clubbed in his income. In case of any gift made to spouse, even then these provisions are retracted. Section 64 subsection 4 talks about it. It says income resulting from any asset transferred to the spouse either directly or indirectly. Now direct transfer, there should not be any confusion. Meaning of this term indirectly we'll see later. Now such an income would be assessed in the hands of the transferor. Now what is the meaning of the term indirectly? To give an example, for example, husband transfers or gifts money, cash to his wife, and out of this cash, wife buys a property, house property, and she gets income out of it. Here, the transferred asset is actually cash, but it has changed its nature. It is from cash, it has become house property. Now, even in that case, this restriction is attracted. So here there is an indirect transfer of the house. So the provisions of section 64 are attracted and income is assessed in the hands of the husband. But there are certain exceptions to this clause. It says, first, the transfer is for adequate consideration. Because once there is adequate consideration, it is not called as a gift, it becomes a sale. So if the consideration is adequate, then there is no question of clubbing of income. And if the transfer is pursuant to an agreement to live apart, it's an agreement between husband and wife to live apart, and as a condition for this living apart, if a gift is made, then the provisions of section 64 are not attracted. Section also says that when provisions of section 27(1) are applicable, this section is not attracted. This is basically almost these provisions can be overlapping, because section 27 also says that when owner of a house property transfers the house property to his spouse, okay, then the resultant income is taxed in the hands of the transferor. So basically the similar provision. So if section is covered by section 27, then the section 64 is not attracted. Section 64 subsection 6 says that similarly, when income from an asset is transferred to son's wife, either directly or indirectly, the income is taxed in the hands of the transferor. Direct transfer, there's no confusion. Indirect transfer, as I said earlier, it changes its shape or form. Even then, provisions are attracted. Okay. Again, here the transfer should be without adequate consideration. If the transfer is for adequate consideration, becomes a sale, and these provisions are not attracted. Now, sections 64, subsections 7 and 8 talk about transfers to other entities. Okay. When the transfer either directly or indirectly to any other person or an association of persons, either to one individual or to a group of persons, okay, without adequate considerations, like a gift, okay, is made, then to the extent to which the resultant income from that asset is for the benefit of the transferor or his spouse or his son's wife, then in that case income is clubbed in the hands of the transferor. Now, for example, an individual transfers an asset to his friend, saying that income from that house is to be received by the individual spouse, either fully or partly. Then in that case, the provisions of section 64 are retracted and income is clubbed in the hands of the transferor. Okay. Now, this benefit can be either immediate or deferred. You can say that the income goes to the spouse either immediately or say after lapse of certain time or event. Okay. So in either case, provisions of clubbing are attracted. Coming to minor children, section 64 subsection 1a says that all income of the minor are clubbed with that of the parent. Okay. All income from any source, whether transferred by the parent or not, it is assessed in the hands of the parent. Now, which of the parent? Income would be clubbed with the income of the parent having higher income. As I said earlier case, once income is clubbed, it continues to be clubbed in the hands of the same person, even though later on that person's income is reduced from that of his spouse. Okay. But only exception is that if the assessing officer feels that this clubbing should be done in the hands of the other person, then he can change it, not otherwise. Okay. Suppose now a minor has some income it is clubbed in the hands of the father. So it continues to be assessed in the hands of the father. But afterwards, even if the wife's income goes up, even if mother's income goes up, the clubbing will not change. It will continue to be assessed in the hands of the father. Now, there are certain exceptions to this clubbing income of the minor. One is that the child does not suffer from any specified disabilities mentioned in section 80U, like autism or mental disorders, etc., etc. Okay. Or if the minor's income arises from his manual skill or any talent or specialized knowledge, like many child artists are there who give performance of singing, acting, etc. So in that case, it is due to their individual skill. Okay. Then income may not be clubbed with that of the parent. Section 64(2) talks about a situation where income is transferred to the Hindu undivided family. It says a member, when transfers his individual property to the family, okay, then income would be clubbed. Income from that property would be clubbed with his income. Okay. And what happens when there is a partition of the family? Section says that in such a case, on partition, the income received by the spouse, okay, will be clubbed with that of the transferor. Yes, friends, and that's about clubbing of income. In case you have any queries, please leave a comment. Thank you again.